Well, here's an issue. I give away $5 million, and when I die, the estate tax exemption is only $1 million. And you can convince yourself that the way the estate tax is calculated when I die, because what do we have to add to my taxable estate when I die in order to determine the estate tax? Adjusted taxable gifts. And I've made a $5 million adjusted taxable gift. And it's arguable that therefore $4 million of the $5 million exemption I used in 2011 or 12 is going to be recaptured and subjected to estate tax when I die. When this bill was going through the Congress after Barack Obama, Mitch McConnell, and John Kyle made their deal in December, I called some people in Washington, D.C. in the tax writing committees, and I said, there's this potential problem, get it fixed. They said, we agree, nobody intends to recapture. I got a call an hour later and said, Jonathan, we have a little problem. We can't dot an I, we can't add a comma. Nobody can change a word. And you may or may not remember, Nancy Pelosi said, I will not accept this bill as it's coming to me. There will be some changes. But she did. There was not one thing added, one thing taken away. Now, the Treasury has told us that they think it is uncertain. I am told, if you can believe the politicians. By the way, do you know how you can tell when a politician is lying? When you see his lips move. Okay? But I've been told that they're gonna fix this up. But even if they don't, if your assets go from $5 million layered to $29 million, even if there's recapture, still $25 million stays out of your estate. It's only the dollar amount that would be recaptured. And again, I don't think it's going to happen. I think it will ultimately be clarified, but we'll see. Now, the other thing, what about the loss of the step-up in basis at death? Now, this is an issue. If you continue to own the assets, let's say you have $29 million, let's say the basis is $8 million, you got $21 million of inherent gain in there, some might even be ordinary as opposed to long-term capital gain, you're going to say, hey, that's a downside of doing this. This trust that my wife Diana has created for me is what kind of trust from an income tax perspective? When a wife creates a trust for her husband, it is a grantor trust. And who is the grantor for this purpose, Diana? You created the trust for me, but who's the grantor? She is. And the trust that I create for Diana, David, is a grantor trust with respect to me. What will happen from time to time, I will go to the trustee of the trust and say, hey, you've got these highly appreciated assets, let me buy it for cash. Or let me trade my high basis assets for your low basis assets. I had a woman who had created a grantor trust. And her son, I kept telling the family, when she gets sick, you've got to call me and let me know. So one day, this is about 5 years ago, her son called me and said, Jonathan, you told me to call you when my mom was ill. She's in the hospital. She's going to die within a week. She's under an oxygen tent, and she's incompetent. What are we going to do? And I said, you're going to come with me. We're going to go to J.P. Morgan, and we borrowed $18 million in cash. And we borrowed that money in her name through the power of attorney she had given him, and then we bought the $18 million of assets, which only had a $2 million basis, from the grantor trust. When she died 5 days later, the trust had $18 million of cash. What is the basis of cash? Cash. Cash, its face amount. And now she owned the $18 million of assets with a $2 million basis, but when she died, what happened? There was a step up in basis. And the day after that, we had the trustee take the cash and buy the assets back, and we repaid the loan to J.P. Morgan. By the way, between the city, state, and federal taxes, we saved approximately $4 million of income tax by doing that. And one of the nice things about this, when you're using grantor trust, it gives you a reason to constantly stay in contact with your client. You've got to tell us if there's a change in health. You've got to tell us if the trustee's planning to make a big sale of something, because that is going to be taxed back to the grantor, and maybe what you want to do is to substitute assets at that time. So this is a most extraordinary event. It is absolutely. Now, I want to talk about 4 other things. I'm going to talk a little bit about this concept of portability. I'm also going to talk about something that Mitch Gans, Diana, and I developed called the Supercharged Credit Shelter Trust, which is a super idea. And it's not only a super idea for your clients, it's a super idea for you, because you get to create 2 new trusts for all your married clients. First marriage, second marriage. By the way, whether they're rich or poor or kind of medium. This is a phenomenal opportunity for them, but it's also a phenomenal opportunity for you. I'm also going to talk a little bit about Alaska community property, which again is a phenomenal opportunity for your clients and a phenomenal opportunity for you because you get to do an additional trust for your clients. And finally, I'm going to talk a little bit about a recent change to Circular 230. You ever heard of Circular 230? Ever heard of it? Yeah, okay. Well, we're going to talk about those things. We're not going to have an awful lot of time to go through them, but let's talk about portability. As we know, beginning this year, if a spouse dies and doesn't use her full estate tax exemption, it basically can be inherited by the surviving spouse. Now, to get that inheritance, you have to file a return. Now, by the way, the big thing is here, portability is going to make it so simple, you can do these simple I love you wills. John leaves it all to Laird. He loves her. No complications, no credit shelter trust. It's so simple. Mark my words, portability will substantially increase planning. It will make it more complicated than before. One of the reasons, whenever you have a choice, you have to go to the lawyers, the Pharisees, and say, and they'll say, on the one hand, on the other hand, let us run some numbers, let us have different provisions in your instrument, and all of a sudden it has become much more complicated and much more expensive. It is a ruse. And by the way, right now, portability is a mirage. It's a mirage because it goes away at the end of next year. So essentially you have to have both a husband and wife die within the next few months. And that kind of planning, you're almost always better off. Now, Diana and Robert Weiss, I wasn't part of this, did a big study comparing portability to credit shelter trust. And Ms. Zadel, what is the conclusion? You still have to do a credit shelter trust. But again, this will be great for you because you're going to say, oh, we got to consider all these possibilities, and we're going to charge you to tell you all about it. Now, here, you're almost always better, even if this is made permanent, you're almost better off one. The GST exemption is not portable. And if you have grandkids, or you hope you have grandkids, you're going to have to do the credit shelter trust in order to do it, or you're going to have to do a reverse Q-tip. And once you're in that kind of complication land, you might as well go ahead and do it. One of the other things, and I posted this on the ACTEC listserv the other day, suppose you live in New York. New York has a $1 million estate tax exemption, but it doesn't have portability. So if I ever want to make effective use of my New York exemption, I've got to do at least $1 million credit shelter trust. Hell, once you're in for a penny, you're in for a pound. And again, now we have it complicated. Well, maybe what you have to do is you have to have this credit shelter trust for New York, but we'll do the balance as portability, but we'll put in something, but if they do this, maybe by disclaimer or otherwise, then we're going to have a credit shelter trust for the balance. Or at least we'll have a reverse Q-tip trust for the balance. I promise you, you should pray at your house of worship that Congress makes this permanent, because it will make it that much more complicated for your clients. And the joke is that the bar associations have sold this to Congress, that it will simplify things. It's a lie. It's going to complicate it terribly. No GST exemption, asset protection. You can't imagine the number of men who've said to me, yeah, I'll probably die before my wife, and I'm going to be really angry if some man gets his hands on my wife. But I'll be damned if he'll get his hands on my money. Well, if you're going to go ahead and try to use portability, it's going outright to your spouse, which means the new husband, the new boyfriend, the pool boy, or if it's the wife, think about this, men are big suckers, you know, the girl who cuts his hair is going to go ahead and get it all. I mean, it's madness. Again, what's the most important thing you do for your clients? Absolutely the number one most important thing. What?
Trust.
Trust! Trust! Whenever somebody asks you a question, you say, oh, trust. Trust will take care of it. Income splitting. If you got a trust, it's a separate and independent taxpayer. You can do income splitting and pay lower taxes. You leave it to the surviving spouse. There's none of that. Gift tax avoidance. You have it in a credit shelter trust. You can make distributions to the kids, no tax. But if it goes to the spouse and he or she wants to get money to the kids, you've now got to run the gift tax gauntlet. Management protection, you get it, and shield from friends and relatives. My My father had an expression, don't take it as too sexist, but he used to say, you can never tell what a jury or a widow woman is going to do. And all I know is that when the patriarch dies, or sometimes the matriarch and the spouse is alone, and then the kids come in and say, we want something, her ability to resist saying, take whatever you want, is diminished. But if it's in trust, she could say, ask the trustee, and the trustee, of course, is going to say no. I had a family where I insisted that the money for the daughters go in trust, and one of the daughters called me up and said, this is the greatest thing you ever did for me, Jonathan, because my roommate from college, who's my closest friend, called me and asked me to invest $2 million in her business, which is failing. And if I owned the money, I could not say no unless I wanted to terminate the relationship, which would have been horrible for me because I care about her very much. But I said, I'll go to the trustee. And you know what the trustee said? No.